Yesterday, I participated in a panel on the impact of financial development on growth and poverty reduction. The title of my presentation was "It's Access Stupid and Avoiding Crisis," which summarizes my main message. The message is that financial development contributes to growth and to reducing inequality insofar as it actually increases access to financial services by everybody, not only by the large firms, but by small and medium-sized firms, and not only by the rich households, but by the middle-income and poor households. And I showed why, in theory, it is only when the financial sector reaches everybody that it can have an important impact in growth and in reducing inequality. I also showed how the normal measures of financial development that we use in economics, and when we talk about the size of the financial sector or the size of capital flows from outside, they are not good indicators of access. Normally, of course, with a very small financial sector, you won't have access for everybody. But you can also have a very large financial sector that gives a lot of loans to very few, and most of the population is without access. So it is no surprise that the empirical work has shown that sometimes financial development do not reduce inequality but increases inequality, when this is the way that financial development goes. When it is really democratizing the access to financial services, it helps to reduce inequality. And it is no surprise that opening to international financial markets sometimes is not good neither for inequality nor for growth. And the reason is that actually the firms that have access to external markets are only the largest, which already have access to domestic. So directly, financial integration don't do too much to broaden access. It could do it indirectly if financial integration helps to develop a broad domestic financial system. But this doesn't always happen because it depends on the quality of your institutions, on how strong is already your domestic financial sector when you open up. And so if you do premature financial integration, you may end up with a more reduced domestic financial sector, and you may also have crisis. And crisis, financial crisis or currency crisis, are very bad for development and for poverty. They reduce growth in the long term, they increase poverty, so the development of a financial sector has to be very careful, not to run too fast in a way that you may end up in a big financial crisis. So these were basically my messages, and then I showed how this should orient financial policies. The focus on increased access on small and medium enterprises and poor households, and also care about not letting big credit booms or big booms of capital inflows create conditions for a crisis.